If you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and here with me today is Rosie Bullard, Portfolio Manager for James Hambro and Partners. Hello Rosie.
Good morning.
So hot topic at the moment, structured products. I thought we perhaps could start with asking what exactly are they?
Well, a structured product has a very broad definition. It's a pre-packaged product based around a series of derivatives. And really, through a structured product, you can get exposure to a range of different underlying assets. It could be single stocks, baskets of stocks, indices. You can get exposure to commodities, debt, foreign exchange. It's almost a definition a little bit like a hedge fund, in the fact that it's very broad brush and can really encompass a range of different underlying exposure and risk being taken as well.
And a bit like hedge funds, there are good ones and there are bad ones. Structured products got tarred with an almightily bad brush a couple of years ago. What went wrong?
I think it was really a lack of understanding in what the structured products were meant to achieve and indeed the risks being taken. So be it understanding counterparty risk, who is on the other side of those derivatives trades, and particularly in the financial crisis, understanding whether that counterparty may be at risk of default or not. I think a lot of investors didn't understand how the structured product was going to achieve its end returns, i.e. if there were hurdle rates to be met, how were those hurdle rates going to be met, and were there multiple hurdles that had to be met in order to provide the returns that were expected from the particular product. There was also a lot of scrutiny about fees, this charging structure of the product itself. How was that calculated in terms of what the structurer was taking and indeed the counterparty in terms of the derivatives being structured around that note, how they were taking their fees as well. And a lot of them turned out to be very, very expensive when one opened up the car bonnet and really looked at what was inside the product itself.
I mean, you've mentioned there the sort of wide-ranging and often complexity of these structures. One of the things I think also added to that confusion is they can be called so many different things. Somebody might call it a structured product, some people might call it a guaranteed income plan, some people might call it a cash-like investment, bond-like investment. But the bottom line was these products were offering what looked like guaranteed income with capital preservation, which brings us to why they're beginning to sort of be back in the investor's mind, is because in this post-retirement space, now that we don't have to buy an annuity, people are looking for the sort of product that these sounds like. They're looking for guaranteed income and they're looking for capital preservation. I mean, what's the alternative if it's not annuity and it's not structured product?
I think wherever one hears the word guarantee, you have to work out why is that guaranteed and what's it going to cost me in order to get that guarantee. A lot of investors are concerned about bond markets looking overvalued, of equities perhaps having run too far. But if structured products are based on those underlying asset classes anyway, it's going to cost you quite a lot in order to buy a structured product that's going to guarantee you an income and also guarantee you that you're going to have capital preservation. And really it comes down to, as with any portfolio, understanding what that particular product is doing, why it's doing it, what your returns are going to be, what the volatility is going to be, and most importantly, how it fits within your overall structure. What have you got in the portfolio already, and what is this structured product going to provide in return?
And if you're not willing to pay those fees, what can people be doing to look in that sort of post-retirement space? With their SIP, perhaps?
I think there's been a lot of scrutiny about SIPs and what's going to happen post the 5th of April in terms of what people are actually going to do with that money. We've still got a very beneficial environment for long-term investors within SIPs, where you can have very high levels of tax efficiency, be it capital gains tax efficiency or income tax as well. If your portfolio is already structured with some high quality yield equities, we don't feel a need to touch those investments at the moment. Equities, of course, run a long way since the lows of the financial crisis, but in our mind, they're not looking overvalued at this point. You've always got to be careful with what you're holding inside your SIP, as indeed any portfolio, what valuation point it's got to, and when you're going to take profits. But I don't think there's a need to rush out of the door, sell all your bonds, sell all your equities, and try and buy lots of capital protection, when it could actually cost you a lot of money.
Rosie, thank you very much.
Great, thanks.
This is Emma Wall from Morningstar. Thank you for watching.